Welcome. In this video, XCN may increase by 16% today or tomorrow. What is the reason? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
First of all, the phrase "such a downtrend exists" in technical analysis means that the price has been moving downward for a certain period of time, indicating that sellers are stronger than buyers in the market. Supply is outweighing demand, and this situation can be visualized on the chart with a trend line. A downtrend is usually characterized by the price making lower highs and lower lows with each attempt. In this case, mentioning that the price must break above a downtrend line points to the possibility of the market regaining strength and escaping the pressure of sellers. In technical analysis, trend lines are one of the most basic tools to understand the direction of price movement and to see possible reversal points. The downtrend line is drawn on the chart through the peak points as a downward sloping line. This line represents the obstacle in front of the price, a symbol of selling pressure. Therefore, if the price breaks this trend line to the upside, the likelihood of buyers regaining control of the market strengthens. Talking about the necessity of breaking the downtrend actually points to searching for reversal signals in technical analysis, because in market psychology, the downtrend line is considered by many investors as a strong resistance zone. When investors see that the price cannot break these levels, they tend to increase selling, but when the price breaks this line to the upside with strong volume, the market perception begins to change. At this point, it is thought that buyers, not sellers, have become more dominant in the market. This breakout may sometimes indicate only a short-term correction, or it may signal the beginning of a new uptrend. The most important factor here is the sustainability of the breakout. If the price only briefly moves above the trend line, this is called a false breakout and can mislead investors. However, if the price starts closing daily candles above the trend line, it can be considered that the downtrend has ended and the market has found a new direction. This process is also related to the psychological side of the market, because while the downtrend continues, most investors are in a pessimistic mood, thinking that prices will fall further. At this time, new buyers are hesitant to enter the market, but when the price breaks the trend line and gains upward momentum, the psychology reverses. Investors who previously believed the decline would continue now become convinced that an uptrend will begin and enter the market as buyers. At this point, the trend reversal turns into a self-reinforcing cycle, not only technically, but also psychologically. In other words, breaking the downtrend means not only passing a line, but also a change in market perception. Another important point to consider when talking about the necessity of breaking the downtrend is the possible retest movement after the breakout. Often, after the price breaks the trend line, it returns to test the same line again. This movement is considered in technical analysis as a sign of a healthy breakout, because when the price comes back and finds support from the trend line, it shows that this line is no longer resistance, but has turned into support. The price bouncing upward from this support increases the likelihood that the uptrend will continue more strongly. Therefore, investors should pay attention not only to the breakout moment, but also to the price behavior after the breakout. In addition, breaking a downtrend should also be examined in different time frames. For example, a breakout seen on the hourly chart may still be within the downtrend on the daily chart. Therefore, it's important for investors to check different time frames to protect themselves from false signals. Breakouts on daily or weekly charts are generally considered stronger and more reliable because they point to a general market trend change rather than short-term manipulation. Breaking a downtrend is often seen as an opportunity point for investors, because taking a position at the beginning of a newly forming uptrend is advantageous in terms of risk-reward ratio. However, it is also necessary to be patient and confirm that the trend has truly been broken. Acting too early and getting caught in false breakouts can cause losses. This is why confirmation is a critical concept for disciplined investors in trend breakouts. Confirmation is usually obtained through several candle closes, volume support, or additional indicators. It is in the nature of markets that trends constantly change. No decline lasts forever and no rise is eternal. Therefore, the necessity of breaking a downtrend is actually a reflection of the natural cycle of the market. After a certain period of decline, buyers may re-enter the market at attractive price levels and turn the direction upward. At this point, the downtrend line is like a symbolic gate for the return of buyers to the market. When the gate is broken, a new period of uptrend begins inside. From all these perspectives, the statement that the price must break the downtrend in technical analysis points not only to a condition, but also to the power struggle in the market, investor psychology, the nature of trend reversals, and the gateway to potential future upward movements. This is why downtrend breakouts are always closely watched and occupy an important place in investor strategies, because the breakout of a trend is one of the strongest signals that can change the direction of the market. And if this signal is read correctly, it can offer great opportunities. That is why the price breaking the downtrend is not just a technical detail, but a sign that a new story may be written in the market. When investors look at the chart to understand this story, they see not only lines, but also market psychology, supply and demand balance, and potential future scenarios. When the price manages to stay above the downtrend and begins to make new highs and lows, the foundations of a new uptrend are laid, bringing hope, excitement, and a new vision to the market. But we can't decide on analysis with only trends, so let's look at the other metrics as well. Keep watching.
One of the most important factors to pay attention to when interpreting price movements with the RSI indicator is the resistance and support zones that form above or below the RSI levels. The situation being discussed here is the presence of a resistance zone just above the RSI. From a technical analysis perspective, this is an extremely critical structure because the RSI measures not only price movements, but also the market's momentum and investors' psychological tendencies. If the RSI approaches a certain resistance zone, this usually indicates that the struggle between buyers and sellers is intensifying. When buyers start to gain strength, the RSI attempts to break this resistance level. If the resistance is broken, expectations for new momentum and price increases in the market grow stronger. This is because an RSI breakout does not only mean the indicator is rising, but also signals that buyers are starting to dominate the market. RSI is an oscillator that ranges between 0 and 100 and is generally considered oversold below 30 and overbought above 70. However, thinking only within these limits can sometimes be misleading. Resistance and support levels that form on the RSI, just like on the price chart, also give strong signals. If the RSI has struggled at a certain level for a while and repeatedly pulled back from it, then that area becomes a resistance zone. In this case, investors believe that once this level is broken, the trend will accelerate. This is because the resistance zone represents a point where sellers are strong. Once the RSI breaks this level, it indicates that sellers' strength is weakening and buyers are taking control. Therefore, when resistance above the RSI is broken, a price increase becomes highly likely. This phenomenon becomes more meaningful when viewed from a psychological perspective as well. Investors focus on certain levels in the market, and these levels become critical both on the price chart and on the indicators. When resistance on the RSI is broken, investors generally interpret this positively. This breakout is seen as a signal supporting upward price movement. In such a case, market participants take long positions, which triggers price increases. This cycle is a chain reaction mechanism frequently observed in technical analysis. In other words, the expectation that prices will rise if the RSI breaks its resistance is not only a theoretical assumption, but also a market reality observed many times. At this point, it is also important to note at which levels the RSI encounters resistance. For example, if the RSI faces resistance just above the 50 level, breaking it can be a much stronger signal for price. This is because staying above 50 is usually considered a sign of a bull market. If the RSI has been moving around below 50 and suddenly rises and breaks resistance, this means both momentum has increased and the likelihood of price gaining trend strength is higher. Similarly, if the RSI has faced resistance around the 60 or 70 band and is stuck there, breaking this level often creates strong expectations for faster price increases. Right after such a breakout, clear upward moves can also be seen on the price chart. Resistance breakouts on the RSI can also indicate trend reversals or trend continuations. For example, if the price has been moving sideways for a long time and the RSI has repeatedly pulled back from the same resistance, this shows that the price is being suppressed. But if the RSI eventually breaks this resistance, that pressure disappears and gives a signal that price will move in a new direction. This signal is often upward, because when the RSI breaks resistance, it shows that investors are demonstrating stronger buying intent. As sellers retreat, buyers become more eager, which naturally leads to price increases.
The connection between RSI resistance breakouts and price increases can also be evaluated from a broader perspective. In markets, technical analysis is not just about looking at charts, it is also a way of measuring collective psychology.
The price attempting to form a W pattern on the chart is considered a very strong and positive development in technical analysis. The W pattern is a structure that investors and technical analysts have been carefully following for many years, showing that prices are making an upward reversal from bottom regions and that this reversal may signal a lasting rise. At its core, the pattern begins with the price making a low, then rising by a certain degree, followed by another pullback forming a second low, and finally moving upward again to break above the first peak. Once this process is complete, the image that emerges resembles the letter W, made up of two bottoms with a peak in between. For this reason, the W pattern is often also known as the double bottom pattern. The formation of such a structure means that the price is expected to return to where it started, which in this current scenario brings forth an expectation of a 16% increase. A 16% rise is a fairly strong and satisfying gain potential, especially in the short term. At the same time, the process of this pattern forming and its psychological reflections are very important because understanding how investor behavior collectively reflects on the chart is far more valuable than just seeing the numbers. The first leg of the W pattern begins with the price falling sharply. This drop usually represents panic selling, profit-taking, and a loss of confidence in the market. However, when the price finds support and pauses at a certain point, it indicates that buyers are beginning to step in. The first bottom that forms here creates the first half of the W. The price then partially recovers and moves upward. This rise often shows that the market has begun to recover, but confidence has not yet been fully regained. At the end of this rise, a peak forms. This peak, however, usually encounters strong resistance and the price begins to fall again. The second decline is a critical process that shows investors still don't fully trust the market, yet this decline usually does not break the previous bottom level. While it may approach it, buyers step in again around that zone. The second bottom forms here, signaling that the market is actually pulling back one last time to gather strength. The rise after the second bottom is the most critical stage of the pattern. As the price starts moving upward again, investor confidence strengthens, buying activity increases, and the price gains accelerating momentum. At this stage, the price needs to break above the middle peak of the W, which is the resistance zone. If this happens, the W pattern is considered complete and the price typically enters a strong upward trend to return to its starting point. At this stage, the 16% increase expectation comes directly from the technical target of the pattern. One of the general characteristics of W patterns is that the target level is calculated by adding the distance between the bottom and the peak of the formation upward. In other words, the price has the potential to rise by the height of the formation itself. For this reason, the calculated 16% upside potential in the current scenario is based on a purely technical reality. From a psychological perspective, the W pattern also provides strong confidence to investors. When investors who left the market during the first drop see that the price does not fall further on the second attempt, they begin to show renewed interest. This represents the return of collective confidence. When investors think the price is holding here, it's not going any lower, buying activity intensifies, which pushes the price upward quickly. At this point, technical analysis and investor psychology once again converge in the same place. The 16% rise target is not just a technical forecast, but also a reflection of collective investor expectations. When many analysts see the same formation in the market, they act accordingly, and this creates a self-fulfilling cycle. As the price rises towards its starting point, investors who previously hesitated to enter the market also take action. This creates a chain reaction, causing the price to rise even faster. Especially when trading volume clearly increases around the completion of the W pattern, this expectation becomes even stronger. Thus, we don't just see a drawing on the chart, but also observe investor behavior being directly reflected in it. From a technical analysis standpoint, once the W pattern is successfully completed, the probability of the price reaching its target is quite high. Therefore, the 16% increase potential is not merely an optimistic forecast, but a technically validated possibility.
Moreover, this rise not only provides investors with short-term gains, but also gives important clues about the direction of the trend. Because the W pattern is not just a small correction before a rise, it often signals the beginning of a long-term upward trend. For this reason, the emergence of such a pattern is considered a very positive development for investors. That said, the price may face certain resistance levels during the formation of the W. Breaking above the peak formed at the midpoint is the most critical threshold for investors. If this level is broken strongly to the upside, the probability of the price reaching the 16% target becomes much higher. If not, the pattern could fail and the price may move sideways or downward for a while. Still, the idea that the price should return to its starting point supports positive expectations among investors. Another factor to consider during the W formation is trading volume. Volume is the most important indicator of how strong price movements are. If volume increases as the price rises from the second bottom, it signals that the buying activity is strong and sustainable. This means investor confidence has returned to the market, making the possibility of the price returning to its starting point much stronger. At this stage, the 16% upside potential seems almost inevitable. In summary, the attempt of the price to form a W pattern is a very strong positive signal in technical analysis. If this formation is completed, the price is expected to return to its starting point, which implies a 16% upside potential. The calculation of technical targets combined with investor psychology makes such an expectation highly reasonable. Therefore, the successful completion of the W formation in the current situation would be a very favorable development for investors, and a 16% potential gain could create strong short-term momentum in the market.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.